to go and give you the highlights. I'm going to tape this, and because if it works, I'll share it with others. And if it doesn't work, they will never see it. I'm teasing. You're going to pass tomorrow. You're requesting as well locally. I like it. Let me allow you to do it. Okay, so listen, we're obviously not going to be able to learn things going through this.
Yeah.
What we are going to be doing here is an intellectual inventory.
Yeah.
And what I'm going to do is just kind of tell you the things you need to be aware of. And then it's your job to say, hey, Dean, let's stop here for a minute. This is something I think I could use a little more help on. All right, so here we go. This is the organization of the test itself.
Okay.
Right? And as we said, we've been talking about these categories throughout our journey together.
Mm-hmm.
Said, FINRA says, can you find a customer for you tomorrow? Who cares?
Yeah.
The various customer accounts we have. We were going to get that. Joint tenants, UGMAs, 529s. We said the biggest part of your exam is function 3.
Mm-hmm.
Right? That's where those 91 questions are. And then what happens behind the scenes, back end, right? So can you find a customer? Can you open an account? Can you make an investment? And then what happens behind the scenes is function 4. Now, as I said, I haven't been giving you a hard time because of what a strategic thinker you are. And I told you that I'm not giving you a hard time because unlike a lot of people I've tutored, even though you take a little longer than most of the people I tutor to come up with an answer, there's 2 things I didn't give you a hard time. You are almost always sticking the landing with the right answer. And on the exam itself, you have 3 hours and 45 minutes, and we've never been over that time limit, even when we're talking to each other and shooting the breeze, so to speak. So I don't think you have any problem whatsoever in that. All right, so let's get talk about some of these things that we would find in function 1.
Okay.
Function 1 is about contacts current potential customers by telephone, mail, electronic, develops promotional advertising materials and seeks appropriate approvals to distribute market materials. Now, we have talked, the first test question here, we have talked about, what can you tell me about these types of communications?
A correspondence is less than 25.
Well, 25 or less.
25 or less.
Okay, retail is?
Retail is greater than 25.
That's right. And what about principal approval?
Correspondence can be before or after.
Right on.
Retail, it needs to be approved.
Good job. Okay, we talked about the options disclosure document.
The options disclosure document needs.
Does that have to be? Okay, I'm sorry, I interrupted. Go ahead.
No, you're good. It needs to be given to someone at or prior to the opening of an options account.
That's right. It's called the characteristics and risks of options.
And it needs to be signed and returned within 15 days of account approval.
Excellent. Let me clear up our slide here. Now, again, we're doing the highlights.
Yeah.
So, we're not going to spend the next week going over this stuff. Okay. So, once we make the registration statement, when we're selling new issues, we enter into the cooling off period, which is a minimum of.
Oh, I don't remember that. I don't remember.
20 days.
20 days.
And during that cooling off period, I can send you a preliminary prospectus, also known as a red herring. And how does a preliminary prospectus differ from a final prospectus?
It's not going to show the final share price.
Right on. Now, we have various members of the syndicate.
Yeah.
And are selling group members of the syndicate? Are selling group members?
No.
They are not, right? They're part of a bracket of a syndicate member. And selling group members are liable or not liable for any unsold securities.
They are not liable.
Right on, right on. There's our cooling off period there. So a competitive sale, I'm just going to give you the overview here on some of this stuff. When
Yeah.
the municipalities are selling securities, they're going to do it on a competitive basis. And if it's a competitive basis, they're going to put a notice of sale on the daily, bond buyer.
Yeah.
Then various syndicates will be formed. Now, if they're going to do it on a negotiated basis, then the issuer would select the underwriter.
Yeah.
And then we have the spreads. We said we have the manager's fee, we have the selling concession, and we have the total takedown. And so the components of the spread, I'm using munis because that's the one you're most likely going to see. And in those components of the spread, the manager's fee, the additional takedown, the selling concession, the smallest individual component is the manager's fee. The largest individual component is the selling concession. Now be careful. The total takedown is not an individual component of the spread. It's two. It's the additional takedown and the selling concession. So different question. Largest component, total takedown. Largest individual component, selling concession. Now, as I told you in our time together before we started doing this, they do have questions about compensation. They'll say, you know, your firm gets a 0.5 point as a selling concession and sells 50,000 bonds. What does your firm make, right? So you can expect that. We said we do not use.
Wait, can you say that last part again?
I don't know what I said. What did I say? I don't even know what I said.
So we just talked about, additional takedown plus.
Yeah, additional takedown is what the syndicate members make when on bonds that they give up. So if our total takedown is 7/8, and that's the total takedown, I give a selling group, one of my selling group members, a 0.5 point for concession. That's, you know, 0.5 point is 4/8, and that other what would that be, 3/8 belongs to me as my compensation for being an underwriter.
Right, but the total takedown is additional plus selling.
Plus selling concession, plus the selling concession.
Yeah, and the manager's fee
is the smallest individual component.
And who pays that?
Well, that's the manager has all the money. So when we're done, the difference between what the issuer receives and the public pays is called the spread. And the manager has all the money. He's going to settle up with the syndicate. He's just going to keep whatever he's entitled to as manager. You remember the definition of a quib?
Qualified institutional.
Yeah, but how much money you need to be a quib?
You need to have.
How much assets under management?
This is the big one.
That's right.
Because an accredited investor is 1 million, so this one's 100
million.
Yeah,
accredited investors also, remember, I got them both highlighted. That's 1, 2, 3. Right, $1 million net worth.
I remember. It's $1 million net worth less primary residence. If you're an individual, 200 grand, and
that's right.
200 grand salary for the last 2 years. If you're married, it's 300 grand the last 2 years.
Right. And what about a quib? You still got to tell me what a quib is.
100 million.
Excellent. They can buy unregistered foreign and domestic securities. The maximum we can raise in a Reg A offering is up to $75 million.
Yep. And then I remember like tier Reg A.
Yeah, we have tier 1 and tier 2. Tier 2 is when we take it all the way up to the 75. And then it's going to be some.
Tier 1 is 20.
It's correct. Remember, we also have another safe harbor called a Rule 147.
Yep, intrastate.
And that's 80% test, right? The 80% test. The issuer has to have 80% of their assets and business within the state. We only can sell it to residents of the state. And remember, after 6 months, non-residents can purchase it.
So the 80% test is issuer needs 80%.
For the issuer, that's right.
So it's 80% of securities in the state?
No, 100% of the securities in the state. You cannot sell these securities to somebody who's not a resident of the state. The issuer The issuer has to have 80% of its business and assets within the state.
Yeah, that's what I meant. Sorry.
All right. Okay, so we're just hitting the highlights here. We're hitting the highlights. We're on function 2. So now we found a customer. Woohoo.
Okay.
Now we got to open an account. So, one type of account we have is for a pattern day trader.
Yeah.
And their minimum equity is going to be $25,000.
Yeah.
We have prime brokers. We have delivery versus payment or receipt versus payment, where we have up to 35 calendar days to make delivery. We have tenants in common, where there is fractional ownership, and the decedent share goes to their estate or beneficiary.
If it goes to the estate.
That's right. We have joint tenants with rights of survivorship. Right. We have all those things we talked about. We have retirement plans that we've discussed.
Yeah.
We talked briefly about distribution options on some of those stuff. As I say, this isn't as big a deal as function 3, which is making investments. So, boom. Customer screening. So,
do you think it's important to know like a ton of differences between like a Roth IRA and a traditional?
No, I know the big things. You should know that a Roth has no required minimum distributions. You should know Roth, you're using your way you always say it, post-tax money, after-tax money. You definitely need to know about the customer identification program. And the biggest part of this is that to open the account, we need a picture ID.
Yeah, I know that.
Picture ID, right? And if we don't have some way of verifying that you are who you claim to be, then we're going to have to, close the account.
Yeah.
All right. So I'm going quickly because this is where we want to spend the most of our remaining time together.
Okay.
So this is 91 questions in function 3. So now that you have a customer and you, tell them about investments and do these kind of things. And it's mainly about the investments. And you did ask me, and I think we did a pretty good job covering alpha and beta.
Yeah. I feel good about those.
Yeah. And we said that's the underpinnings of what we call the capital asset pricing model.
Which is cost of equity.
Yeah. We talked about a balance sheet, and then we talked about some of the things on a balance sheet. I don't think being a fundamentalist is going to be a big deal for you tomorrow.
Yeah.
But, we talked about the classical balance sheet equation. And we talked about liquidity. We talked about working capital, current ratio, asset test. Those are mainly recognition, but on a bad draw, they might actually make you do it, right?
Yeah.
And we said the biggest part of this is this part of this function for 3.
I just hope there's a ton of options.
No, you're good at options. You were really good the other day on options. We're coming up on options. So remember, we need to know about stocks. We talked about the definitions of authorized, issued, outstanding, treasury. Par value for common stock is $1. Who cares? We talked about your preemptive right, your right to maintain proportionate ownership. We said the mechanism is a rights offering. We said if there is a rights offering, the rights are going to be short-term and exercisable below the current market price. We said as many rights as you have, that's how many rights you have. We said you do not have a right to a dividend unless declared. But once the company declares a dividend, it becomes a current liability. And then at that point, you'd be entitled to your pro rata share of that. We talked about voting. Now, I think I mentioned this to you. There is super voting. Did we talk about that? You might very well encounter super voting tomorrow.
So super voting, I remember you mentioned it, but I don't.
Super voting are simply shares that have more than one vote per share.
And those are tied to what normally?
Well, like, Zuckerberg, he doesn't have the same stock you and I would have in Facebook. His Facebook stock that he owns gives him 100 votes per share. So even though he only owns, I don't know, I'm just guessing 20% of Facebook, he still has 50.1% of the votes. So, we're not going to boot him out of there. The Ford Motor Company, the Ford family has Ford Motor Company B shares. They have 10 shares per vote. The
So,
residual claim we talked about is known as book value, right? So we liquidate the corporation. Remember, the common stockholders are last in line. They're the most junior security.
it's secured bonds,
Very testable.
and then you can split it up like secured, unsecured,
Right, preferred and
subordinated debentures, like if you want to really break it out.
they're going to ask you tomorrow to go junior to senior, senior to junior. Very
Preferred.
testable. Very testable.
Common.
You do get tested on penny stocks. Remember the definition of a penny stock?
Less than 5.
That's right, less than 5.
And you get statements monthly.
Yep, indeed. Good job. Remember, you don't get the disclosure document or disclosure suitability statement unless you're not an established customer. So 3 trades, funds for a year, you're established. Preferred stock, lots of preferred stock questions. So remember, cumulative means that it goes into arrears. Non-cumulative means it does not.
Yeah.
Participating means you participate in excess earnings be some stipulated amount. Convertible means that you can convert it into the common stock. Remember, you need to be able to figure out tomorrow the conversion ratio. It's based on par.
Par over CP, which they get.
And then you definitely need to know that preferred stockholders have preferential treatment in both dividends and liquidation. You need to be able to contrast rights and warrants. Warrants, remember, are long-term, exercisable above the current market price.
Yeah.
You're certainly going to get tested on ADRs tomorrow.
I have one question.
Yeah.
For convertible preferred. Oh, never mind.
Okay.
I use par of
100.
Par of, it's 100, right?
Right.
Yeah.
Well, listen, I would just tell you that too, Lauren. I mean, I think sometimes you, as your tutor, I don't know what the right way to say this. I think you know a lot more than you think you know. Let's put it that way. You're usually spot on the stuff that you're trying to articulate. So, and remember the game we're playing, I'm asking you to articulate it with no context and with nothing in front of you. And then tomorrow, remember, you're going to get a question and you're going to get an answer to that. And you know that one of those things they're offering you is indeed true. Right? Okay. So what can you tell me about ADRs? Very testable. Nothing, no draw tomorrow, which you're not going to get an ADR question.
Yeah. An American depository receipt. I always think imports, exports. You can, what's the wording?
Well, test question number 1, this facilitates U.S. citizens have being exposed to foreign securities, foreign companies.
Yep.
Nestle, like California, Mexico. And there you go. That's exactly right. Foreign currency.
And then they can withhold some of the money for tax reasons, but then the government will give you a tax credit.
Perfect. Now, when you are tax treatment of your stocks, your equity securities, when you net all your gains and losses at the end of the year, how much of those losses can you take against your earned income?
$3,000.
Right on.
And you can roll it forward the rest.
That's right. And to qualify for a long-term capital gain test question, how long do you have to be at risk?
12 months.
Right on.
And
calculation of your cost base per share. Do you have to pay taxes if there's a stock dividend or a stock split? Is that a taxable event?
No.
Right. What do you have to do? Adjust your cost basis per share.
Correct.
More shares at a lower price. What's the difference, Lauren, between
if it's cash, then it's
cash, you just pay, there's no adjustment. Cash, you just pay taxes.
Yeah.
So what's the difference if you inherit taxes or inherit securities, excuse me, in terms of your cost basis versus you received gifted securities? So what is the difference in your cost basis if you inherit securities versus somebody gifted you securities?
Oh, that's a good question. I think if you're gifted, I'm thinking about the gift tax, but I don't know if that's It's not taxable to the
Now,
person.
remember, when you inherit securities, there's a step up in the cost basis.
Yeah, there's a
And if
step
you're a
up.
gifted securities, you assume the donor's cost basis,
Yeah,
right? So that's the distinction. Inherited, there's a step up in the cost basis. It's your cost basis is market value at the
the
decedent's
time,
at
at the
death.
time of death.
Right.
Yep.
Gifted, you assume their cost base. Cost valuation, we talked about FIFO, LIFO, and identifying your shares. Which one of those, if you've been buying securities over several time frames and
Mhm.
you haven't kept good records, what will be imposed upon you by the IRS?
First in, first out.
Right on, right on. We talked about ETFs,
Uh-huh.
and we said it was testable now how ETFs are different than traditional open-end funds.
Yeah,
What were some of the distinctions between an ETF and an open-end fund?
I did my little chart yesterday. So, an ETF or a close-ended fund can issue common, preferred, or can.
Yeah, well, that would be the closed-end fund. That's very testable. Closed-end funds can issue more than one class of equity, indeed. But I
Yeah.
didn't ask you about the difference
Oh, you
between
mean
open and closed. I asked you the difference between ETFs and a traditional open-end fund. And what we're looking for here is you can buy an ETF on
intraday?
margin, where you're right, closed-end funds and ETF test questions are continually priced.
Yeah,
They're continually priced.
yeah, you can
Buy them
do,
on margin,
yeah.
right?
Mhm.
Investment trust. What do we know about unit investment trust?
That's a fixed portfolio,
Right
so
on.
you don't consider it to be actively managed because once it's
Perfect.
fixed, it is what it is.
Perfect.
And a mutual fund is actively managed, which means it has
Perfect.
a higher operating cost.
Love it. Love it. You're correct.
There's
Both
forward
ETFs and
pricing.
UITs have tax efficiency. How often
Yeah,
does an open-end fund have to calculate their NAV?
well, it's forward pricing, so it's always calculated at the next day NAV.
That's right. But how often? What's the minimum? Once per business day.
That would have been my guess.
Okay. Now, the NAV plus the sales charge equals the offering price.
Pop, yep,
Pop, indeed. And what is that maximum sales charge?
8.5.
Excellent. Excellent. Now, some funds have a 12B1 fee.
Mm-hmm.
And if they're referring to themselves or want to hold themselves out as a no load fund, what would be the maximum 12B1 fee that they could have?
0.25%.
Excellent. And if it's over the life of the fund, they go past 0.25, they certainly can. They just can't refer to themselves as no load. And over life, it would be 0.75%. We have
0.75.
traditional front load A shares,
Yeah,
and we also have B shares that have a contingent deferred sales charge,
yeah,
a back end load. And so the front end load, remember, is going to be good for somebody who has a large amount to invest in a long time frame.
yeah.
The B share is going to be better for somebody who has a smaller amount to invest, but again, has a long time frame, because then we'll waive that sales charge for them. What do we need to make dollar cost averaging work?
Wait, will you say that again for the front end?
Yeah, I said A shares and B shares. A shares, the traditional front end load shares,
Mm-hmm.
are good for somebody who has a large amount to invest in a long time horizon. And B shares are for anybody who has a long-term hot time horizon, but a less amount to invest.
So can we like talk about that a little bit further? Because when I think about like a front end sales charge, right? Like that's what I'm paying.
Well, we're thinking that with the front end load, you may qualify for a break point.
Oh,
But in
yeah.
a B share, you don't have enough to qualify for the break point. Maybe you're never going to have enough to qualify for the break point. In fact, the test question, the break point is a quantity discount. Is that a good thing or a bad thing, a break point?
Break points are good. A break point sale is bad.
That's right. So break points are quantity discounts. Break point sales is when you try to avoid the break point to maximize your commission.
Yeah.
And we said when given the NAV and the public offering price, you should be able to compute the sales charge.
Yeah,
right? You're pretty good at math.
yeah.
If we're going to dollar cost average, what makes
Uh-huh.
it work is fixed dollars invested regularly,
Yeah.
right? You end up with a lower average cost than those of the underlying shares,
Uh-huh.
and it doesn't guarantee a profit.
Yeah.
Okay, now how can you qualify for the break point if you don't have enough to get there just yet?
You can do a letter of intent,
Which is good for how long?
13 months, and can be backdated 90 days.
Excellent. And who does
But
not, who cannot pull purchases for purposes of meeting or getting the break point?
clubs.
Investment clubs. Excellent. Now, if we
Other
didn't
one?
have,
Isn't there another one?
what, I'm sorry?
Isn't there another one?
I don't think so. I can't think of one off the top of my head. It's testable one.
Okay. I have one other question.
Yeah, go ahead.
For a back end fund, so it's a small amount and over a longer term,
Yeah,
but
because
then,
after 5 years, typically we let you out. We let you stay in without a sales charge. We waive the sales charge.
so
If you
after
don't stay in
5
5 years, if
it's
you
like,
redeem, then we you end up paying the loan.
got it. Okay.
We call
Okay.
this a contingent deferred sales charge.
Got it.
Okay, so if we didn't have subchapter M or the conduit or pipeline theory, mutual funds would pay taxes on the dividends they receive and the interest they receive, dividends from the stocks they're holding, interest on the bonds they're holding, and they would have to pay taxes on that money. They still have to pay taxes on the money they keep. But if they distribute at least how much?
If they distribute 90%.
Right on. That's die 90 dividend net investment income. We're talking about mutual funds, but what's another type of investment vehicle that has that same tax treatment in terms of pass-through?
REIT.
Excellent. So you say you don't need the money. So you just want them to reinvest the dividends and capital gains back into the mutual fund. That's called a DRIP. You will encounter a DRIP tomorrow, dividend reinvestment program. And remember what the IRS says about this, that you could have got the money and you didn't, but that's the same as getting it. And you owe taxes on the reinvestments of dividends and capital gains distributions in a DRIP.
On REIT.
Now that's not the case, it's on your 401k or your IRA or something like that.
But in a mutual.
That's right.
Yeah.
Variable
So
life.
how would it be taxed, right? Like for reinvestment of dividends?
Oh, you're going to get 1099 and it's going to be taxed at either your ordinary income tax rates, if it's a dividend, and if it's capital gain distributions, it's based on how long the fund itself had that security.
Okay. But I think it's important to know that it's taxed, like the reinvestment of dividends.
That's right. It's called constructive receipt. It is testable. All right. So I think we went over, I think you did a pretty good job on variable annuities and this idea of the separate account and the idea of the accumulation units. We talked about that.
Yeah.
And we said that when you have types of election, and we talked about, how you could turn it into an income stream. And we said life only gives you the largest monthly check. And then we talked about how your check is going to go up and down based on the heir, the assumed interest rate. We said if once you annuitize and we turn your accumulation units into annuity units, your check will go up and down based on the heir, the assumed interest rate. If we get more than the heir, check goes up. If we get the actual rate of return is higher than the assumed interest rate, check goes up. If we get the heir, check remains the same.
And then
if it goes down, check goes down.
Can we talk about the distributions from a fixed variable annuity versus variable?
Well, there's no fixed annuity questions at all because it's not a security. On the variable annuity, very testable. Remember, you have a cost basis. You put X number of dollars into variable annuity post-tax.
X dollar, yeah.
And so the difference between your cost basis and what you have at 59.5, that is going to be what you owe taxes on eventually. So when you withdraw, you say, hey, I'd like to get a distribution from my variable annuity. I'm 59.5. and I'd like you to send me X. Now, remember, some of that money that's in there is money you put in post-tax, you've already paid taxes on. And it is testable that it's going to be LIFO. LIFO, last money's in, first money's out.
Last money in, first money out.
If you get stuck tomorrow, always answer what yields the most to the U.S. Treasury.
So it could ask me, okay, you have variable annuity, person is 15
Your
and a
customer
half.
invested $1 million in a variable annuity at 59.5. There's $10 million in the annuity. He does a random distribution or withdrawal of $1 million. That last in, first out, that's $1 million on the 9. He's never paid taxes on. You don't get your money. Now, if it's a check, you get $1,000 a month. 100 is going to be a return of your own money. That's called the exclusion ratio, the amount of money that you already paid taxes on.
Yeah, but it would need to tell me how much money I put in initially, right?
Absolutely, absolutely.
Okay, because then I would, and so let's say I put in $1 million. Okay, I'm 59 and a half. Now it's worth 10. So then I only owe taxes on the 9.
That's right. But remember, if you do a random distribution, random withdrawal, then you're going to owe it's LIFO. That's very testable. Okay, so we talked about REITs. Somebody told me on debrief they got asked about the 3 types of REITs. There are the 3 types of REITs. I'm not sure if I believe them, but right, we have equity REITs where we actually buy the real estate. We lend mortgage REITs, and then a hybrid REIT does a little bit of both.
Okay, wait. Equity REIT is you buy the real estate. Yeah. The mortgage REIT is
mortgages where we're lending money, and we're collecting the interest and the principal on the mortgages that we own, that we've originated or bought in the secondary market.
And then a hybrid is both.
Yeah.
Those are fully taxable.
Yes. So partnerships. So roles and duties of the general partner versus limited partner. So the general partner, remember, test question, has unlimited liability.
Yeah.
Managing the partnership.
Yeah.
And remember, partnerships have a pass-through of profits and losses. They have a flow-through. We have various types of real estate programs. And we are going to ask you about, in the oil and gas category.
Yeah.
In the oil and gas category, which one has the most risk?
Wildcat.
Excellent. And then the other one we're going to ask you is, some of these you get tax credits for. We form a partnership for historic real estate or low-income housing. We're going to get a tax credit. Yeah. So we either are going to distribute these as a private placement or a public offering. So whether we're talking about partnerships, which we're talking about now, or any type of investment, what is the distinction between offering an investment opportunity privately versus offering an investment opportunity publicly?
Privately and publicly you have to think about who you can offer this to.
Right on.
So if it's public, it can only be accredited investors.
No. Public, you can offer it to anybody.
Public, you can offer it to anybody, but it can't be more than 25 non-accredited.
No. We can offer it to any Joe Sixpacks you want to, but then you have to comply with 33. If you're going to sell brand new securities to the public, it's going to be a prospectus. Now, in the private placement category, the key thing is you're buying unregistered securities. In public offerings, you're buying registered securities that have been registered with the SEC. And in a private deal, you're buying unregistered securities. That's where you're at. If you're a accredited investor, you can buy unregistered securities in a Reg D private placement. 506C, we can have on both versions, we can have an unlimited number of accredited investors and institutional investors, and we can solicit. In a 506B, we also can have an unlimited number of investors institutional credit, but no more than 35 who are unaccredited. Those are still both private placements. You're buying unregistered securities.
That's so strange because like in the Notman study guide, I can literally pull up, hold on, let me just pull this bullet up. Because I want to read it to you.
Okay.
Because I memorized it and I want to make sure. So under Reg D, Rule 506B,
None of those are public offerings.
a company, so the way I need to like reframe private versus public. So a company can privately raise an unlimited amount of capital with an unlimited number of accredited and a max of 35.
That's right. And whether
investors.
we're offering stock or whether we're offering partnerships. So these are the types of deals we have to office various types of securities. We're talking now about securities. So
Yeah,
if I'm offering unregistered securities, that person needs to be accredited or sophisticated if it's 506B.
yeah,
If it's 506C, it's accreditation.
yeah. So in 506C allows for public advertising.
Yeah,
It
not
can
public
be
investors.
zero. There can
That's
be zero non-accredited
That's what I
investors. So
told you.
that's where it messed me up though, because I was
Yes,
still
no.
thinking in terms of
No,
public.
public means we can solicit. The way I said that was we can solicit. We can have a radio commercial. Hey, I have a special opportunity for you.
Okay, so I'm gonna think of it in terms of, so this is all under private placement.
That's
for
right.
free,
That's right. Now,
but
you
if
told
it-
me in our time together, you told me you're familiar with business development companies.
Yeah,
Okay. And so remember there, you just can't get your money out anytime you'd like.
yeah.
All right. Here is your area of expertise. And good news for you, there's going to be a lot of these.
Thank God.
So we talked about the OCC Clearing Corporation. We said they test question, are the issuer and guarantor of all options.
Yeah,
We said they assign exercise notices randomly. We said if you're long, you can exercise or you can get assigned. So if you're long, you're going to exercise. And if you're short, you get assigned.
mm-hmm,
And we said if you are exercising, you either have to deliver the stock
mm-hmm,
or deliver cash. If you're long a call, you're going to deliver cash. And the person who's got assigned has to deliver the stock. And we said that the contracts themselves settle T+1.
one, mm-hmm,
We said the resulting exercise in equity options is T+2.
yeah.
We said there are opening and closing transactions, very testable.
Opening.
We said the
purchase.
premium always consists of the intrinsic value and the time value.
Yeah,
We talked about the same side of the market and position limits applying to those. We
yeah.
talked about the difference, very testable, between American and European style.
American is anytime, European is just on the
Right on. We talked
it's
about
just on
leaks,
it's on which date again for European? It's only on,
the last trading day, at expiration.
yeah.
Okay, we said a leap technically is 39 months. In practice, it's 30 months. And we said long-term option contracts always have greater premiums. We said you do covered calls to do what? Why do you do a covered call?
Well, it provides additional
Perfect.
income.
That's exactly right. You
Yeah.
generate additional income. We said we have covered call. We have hedging to hedge either an equity stock position or an index or foreign currency. We said you're going to buy the option.
Mm-hmm.
And so we said if you're hedging a stock, a long stock position, you're going to buy a put.
Yep, you're long.
That's right. If you were hedging a short stock position, you're going to buy a call.
Yeah, that's on my brain dump.
Yeah, there you go. And in index, if you are worried about systematic risk,
Mm-hmm.
your whole portfolio going down, you buy a put on the index that most closely approximates your portfolio. We talked about EPIC. Exporters buy puts to hedge, importers buy calls. I don't know if we talked in our time together about yield-based options. Did we ever talk about that? A yield-based option, if you get this tomorrow, has
Okay.
a direct relationship with interest rates. What I mean by that, so if you think interest rates are going up, you buy a yield-based call. And if you think interest rates are going down, you buy a yield-based put. By the way,
So
you always want
I
to,
just think about bullish versus
that's right.
bearish.
That's right. You always want to kind of be prejudicial about buying an option, because remember, the idea is if you're wrong, you're just going to, lose your premium. Okay,
Mhm.
advanced strategies. I was so impressed with your performance yesterday. Here's some of our advanced strategies.
Yeah, I'm really good at those.
Good. So you have debit spreads tomorrow. You got credit spreads tomorrow. You're going to have straddles tomorrow. You're going to have
Combination,
combination straddles with different strike prices, right?
strike prices or months.
Yep. And don't go naked, right? Bad things are likely to happen. That's not a good thing. Profit or loss, break evens. I think you did very, very well the other day on that. So I'm expecting good things from you. All options trading. All options trading. So not exercise, trading is taxed at short-term rates. So, you buy an option, you sell an option. It's simple. If it's a gain, it's short-term. If it's a loss, it's short-term. The only exception to that would be if you buy a leap call, because you could hold that for more than 12 months. And if it's exercised, for the most part, Lauren, it follows break even. So if I say your client's long an Apple 180 call at 5, he exercises, what's his cost base? It's 185. The only time that's not the case, where it doesn't follow break even, is in a
Mhm.
covered call. And a covered call, your cost base is what you paid for the stock, and your sales proceeds is what the stock gets called at plus the premium. Don't
Yeah,
think it's
the
a big deal.
strike plus the premium.
That's right. All right. So types of bonds we have. We have various types of corporate bonds. We have
Mhm.
secured bonds. We have unsecured bonds. We're going to test you on money market instruments like commercial paper, negotiable jumbo CDs.
Mhm.
We have euro dollar bonds that are issued in Europe, but are denominated in dollars.
Yeah.
So foreign issuer, you don't have any currency risk there. We talked about call risk.
Isn't there something I really need to remember about the jumbo CDs?
Not really, just the
Yeah.
negotiable jumbo CDs, and the negotiable means brokered CDs, and these are found in a money market fund.
Well, I just remember I always got like a couple questions about like how they're insured. And
Well, I'll tell you,
so
up to
if it's
250, up to 250 grand. Banks have FDIC insurance up to 250.
correct, but it's through a bank, it's FDIC, but if it's a broker
That's right.
dealer, then it's SIPC.
Yep, broker, but that's very testable. Broker dealers, it's 500,000, of which no more than 250.
Yeah.
Call risk, I think you're pretty good at this. Call risk is associated with a declining interest rate environment.
Yeah.
Zeros are not callable. US Treasuries are not callable. And we said,
Mhm.
what prevents the issuer from calling the bonds is time and price. We have call protection.
Yeah.
We said, you had a question here the other day we worked and you got it right. You remember the distinction between a equity linked security or exchange traded notes? Please note the category in which it shows up here in the FINRA content outline.
Uh-huh.
These are debt instruments, right?
Yeah,
Or
they're
debt.
debt instruments and the credit quality is actually based on the issuer.
Exactly right. Right. So
And
we said
I
about you
can't
have to
think
know.
equity. Like I can't think equity that it tricks you, but like
Yeah,
I
that's
can't.
exactly right. It's not. That's the trick.
It's debt.
We have the teeter-totter. You're going to get tormented on the teeter-totter.
I got that.
The relationship of these yields, right? That's very testable tomorrow.
Uh-huh. No,
Bond ratings, I would know investment grade is triple B. They're going to use Standard & Poor's tomorrow. Triple B is investment grade. Less than that, it is not. It is not. I wouldn't worry too much about that. I would know the difference of these types of bonds, right? Mortgage bond is secured by real property.
yeah.
Equipment trust, major movable equipment,
Uh-huh.
right? I would know about zero coupon bonds. Zero coupon bonds are going to be very testable tomorrow. They're
Yeah, I
not
got those.
callable. You have
Uh-huh.
to do straight line amortization upward,
Uh-huh. So
called
issued a
accretion, and you owe
discount.
taxes on that. And they're
Yeah.
good for somebody who needs set some money some future date. You're
Uh-huh.
going to get at least one or two questions about parity, calculating parity
Yeah, it's
in a
current
convertible.
market price over the current ratio
That's
or
right. So that's going to
conversion
be
ratio.
testable. Remember, income bonds only pay interest when and if earned.
Yeah.
right? And then we said you can't do a parity calculation without the conversion ratio.
Yeah, which is
Uh,
par.
And you might discover a price discrepancy when doing parity.
Uh-huh.
And so you might be able to do arbitrage.
And an arbitrage is when you can basically make money off of varying prices in different exchanges, right?
That's right. That's right. You can profit from price discrepancies.
Okay.
Munis, you're going to be out of 20 questions on munis tomorrow. And so we said the biggest part is, can you distinguish between GO bonds
Yeah,
and revenue bonds, right?
yeah.
That's going to be the big thing. So general characteristics of mutual fund securities, the legal opinion. I'm sure you're going to get this right.
Unqualified is better.
Yeah. Who does it?
Bond counsel.
Right on, right
But
on.
there was one thing I did get wrong on that. Remember, it was like, okay, what is the bond counsel actually looking at when they give like
Yeah, you said
unqualified?
credit. You missed that. That was a bad miss.
It's not the credit quality of the
No,
issuer.
it is not. It's the legislative authority to borrow the money. The bonds are exempt from 33.
And the
They're
tax
federally
thing.
tax exempt.
Yeah.
We
Okay.
did talk about the bond indenture.
Uh-huh.
And specifically within that, we talked about the flow of funds in a
Net,
fund.
it's assumed net, which means operations and maintenance is paid first.
That's right. Exactly. Remember, we assume net revenue pledge. I believe the other day we did some questions about TANs, BANs, and RANs. Those are
Yeah.
testable. Those are the muni equivalent of borrowing against receivables.
They're short term.
That's right.
And they're tax exempt, which is super important.
That's right. And we talked about advance and pre-refunded bonds that they're going to get called. We talked about a double barrel bonds,
Yeah.
two promises. We talked about those.
Yeah.
We talked about 529 plans being better than Coverdale's.
Wait, can I talk through one thing real quick?
Sure.
On an original issue discount muni bonds, they're obviously issued at a discount, but the yearly accretion is not taxable.
That's right. Only because it's a muni.
Only because it's a muni. However, if you do not hold it to maturity, that's when you get hit.
That's right. That's
and
correct.
you owe taxes on that.
That's right. And so we talked about the 529s versus Coverdale's. Did we talk about local government investment pools? These are money market funds for all intents and purposes where cities, counties, and school districts. It's where the school district and fire department and police pool their money so they can get at least some kind of return for it. But it's a type of municipal security.
I did not know that.
Yeah, I don't know. We talked about calculating accrued interest. Who pays the accrued interest, the buyer or the seller?
If I'm buying it, I pay the accrued interest.
That's right. And
it's so day to date is when interest starts to be accrued and I need to calculate the number of days.
That's right. From the last time it paid interest.
Yeah.
To up to, but not including. Excellent.
T+2.
There you go. We talked about hedge funds being not hedge funds, right? I'm joking, but we talked about hedge funds being organized as private partnerships. We said it's sold as a private placement, so no hedge fund for you if you're Joe Sixpack.
Yeah.
You're going to buy a hedge fund, you got to be an accredited or institutional investor.
Yeah.
And we said since it's organized as a partnership, you have liquidity because the GP could say, sorry, the gate is closed right now, the hedge fund manager. Sometimes we can raise money as a blind pool blank check company, and I raise the money and then tell you what I'm going to do with it. We talked about CMOs, and we said there were PACs and there were TACs.
Yeah, PACs are safer.
That's right. And we said that you have to sign a suitability statement.
We
talked about treasury securities. We said treasury bills are issued and trade at a
discount.
Right
I think
on.
of them like a zero coupon bond.
That's right. We talked about tips.
Inflation protected.
That's right. They get adjusted. Guaranteed you're going to get questions about Ginnie Mae tomorrow. The 3 test questions about Ginnie Mae.
So those have the full backing of the US government.
That's right. Full faith and credit of the United States government. That's one test question. What's another?
They're fully taxed.
Right on there, taxable on both the state and federal level. Indeed, one more. It's the only debt security on the test that pays this way.
Oh, interesting. Wait, I'm gonna write down these 3 bullets.
Yeah,
Hold on.
yeah, that's very taxable. When it's free, remember, it's going to be accept. So Ginnie
So
Mae's fully taxable. They're backed by the full faith and credit of the United States government. And test question, they pay interest and principal monthly. Interest and principal monthly.
interest and principal monthly. So back to the full faith. US government. Okay. And well, oh no, that makes sense because of mortgages.
That's exactly right. And they're passing that through. It's why it's called a pass-through security.
Yeah.
Pass-through security. So we're still in function 3. We're still in function 3.
Which is crazy.
Well, I told you, this is 91 questions.
Yeah.
Disclosures on specific transactions. Material is an important word tomorrow. Material means if you knew it, it would could alter your investment decision. So I saw a broker being interviewed and say, why didn't you tell this person this information? He said, I thought I'd lose the sale. And that's a big, big no-no, right? I say, hey, Lauren, it might alter your investment decision, but something you ought to know. By the way, does the material event have to be disclosed? The answer is yes, right? Because it might alter your investment decision.
But it's the right thing to do.
Well, of course.
Yeah.
And then control relationships are when the BD and the issuer are under common control. The best example, I think, in today's environment is Merrill Lynch and Bank of America. There's a control relationship between Bank of America and Merrill Lynch. And so that has to be disclosed. If you buy Bank of America stock through Merrill Lynch, that's going to be a com firm. A Merrill Lynch broker can't use discretionary authority to buy you Bank of America stock because there's a control relationship and that needs to be disclosed. Now, we talked a little bit, I think, about the difference between systematic and non-systematic risk.
Yeah. So systematic, it is market, and non-systematic is business.
That's right. So which one of these risks can be mitigated through diversification? One can, one cannot on your test tomorrow.
Oh, hold on. Which can be mitigated by diversification. I'm glad you asked me this because I wrote a note to memorize this again.
Well, the biggest thing tonight is to get some sleep, Lauren. So, you don't want to, work so hard to wear yourself out before tomorrow. So,
No, I feel pretty
at
good.
some point you got to call it quits on the stay and say, okay, that's it.
I'm really bad at that.
Well, that's probably why you're successful. So most people have the opposite problem. They quit a little too early. So.
Which can be mitigated by diversification.
Yeah, so that was my standing question. You haven't answered yet. My question to you was, there are 2 types of risk we see here in our content outline. We're doing a low budget Greyhound bus tour through this thing. If you're watching the replay, I know you're saying, oh, Dean's skipping a whole bunch of stuff. I am. I would tell you that you can find this in the playlist where I do the whole thing, and it takes me many hours and videos to do so. Right now, we're just trying to, get Lauren in her flow so that she's ready to go on some of these big picture items tomorrow. All right. So that being said, my question to you still stands: is systematic risk or non-systematic, which one will be mitigated through diversification? The opposite means one of these is not going to be mitigated through diversification.
Non.
Right on. Non-systematic risk, also known as selection risk, can be mitigated through diversification. The easiest way to do it is in a mutual fund. Now, soft dollar arrangements are soft dollar compensation paid by a broker dealer, paid by a broker dealer to an investment advisor. And a broker dealer cannot make soft dollar compensation to an investment advisor for rent, furniture, or travel.
Hold on, can we just go, I don't know what this is. Can we go back to the
Sure.
definition?
Sure. So investment advisors are very good customers of broker dealers. Broker dealers love to have investment advisors who use their broker dealer for execution and custody.
So investment advisors pay.
When they don't know, they get paid. And they
Uh-huh,
don't get paid money, they get paid soft dollar compensation.
so they
So
get
I can
paid by.
call my broker dealer and say, hey, can you pay for a seminar for me? And they go, absolutely, we'll take care of that for you. Can you pay for a computer system that'll help my customers and help me? Because remember, my customers are your customers. Sure. The test question is not what can a broker dealer pay for? The question is what broker dealers cannot pay for. As I said, what they cannot pay for is furniture, rent, and travel. So if the investment advisor calls the broker dealer saying, hey, can you help me on my rent this month? And can you send me to Tahiti to get a vacation? And
That'd be
right.
kind of nice though.
Yeah. Can you buy me some new furniture? No. Okay. So we're still on 3. We said on the customer confirmation, the biggest thing is going to be capacity. Did we act on our broker agency capacity in the transaction, or did we add in our broker dealer capacity?
I just remember from yesterday,
That's right. There you go.
ABC,
That's exactly right.
agent, broker, commission.
Now, if you transfer your account under ACATS,
Uh-huh,
we have 1 business day to verify and 3 days to transfer.
yeah, it's like you have 1 business day, you verify what's in the account,
That's
and then
right on.
3 business days to transfer everything that's in there.
That's right. If we close the account, we keep the record. It's a 6-year record after you close the account. That makes sense because the statute of limitations for arbitration is 6 years. So we don't want to, go into an arbitration case with a customer and they have a record that we do not have.
Yeah, because you have 6 years, to
That's
like,
right.
let's say I had a problem, like I
That's
could
right.
have 6 years to, what's it called, make a.
Now, I think you're going to do pretty good on these because we spent some time on this
Uh-huh,
in terms of the types of orders that we have.
yeah,
Right. And you did pretty good on some of this stuff. You did really good on what you called, you were a little upset with our friends at Knopfman for giving you regulation show questions. Remember, the main thing was that you can't sell short unless you've actually located the security.
yeah,
Now,
that's.
we've talked about types of orders. We talked about subject quotes. We talked about firm quotes. So I think you're in pretty good shape on this part
Wait,
of your exam.
can we just tick through? So like I have
Sure.
fill or kill, which
So,
is.
Fill or kill means you want it all and you want it now, or you don't want any part of it. Right? 10,000 shares, fill or kill.
And then all or none.
10,000 shares, all or none. I'll wait. But I don't want partial execution. I don't want you to tell me, Dean, here's 2,000, here's another 3,000, here's another 1,000. No, I want it in one fill, like fill or kill. I want it in one fill, but I'm willing to wait. Immediate or cancel, remember, means like fill or kill. I want it now. But I will accept partial execution. And I think we just dealt with a market not held order, right? That's where time and price.
Yeah,
I
not
don't need
held,
that.
not held
Means
meaning.
my floor broker has this order. I tell my floor broker, buy 10,000 GE, market not held. Don't tell anybody you have it. And when you think the time and price is right, go ahead and do it for me.
And you have like during the day.
That's right.
By 10,000.
All orders, unless we say differently, are day orders.
And that's a full, like, due during the day, or can it be
Yeah.
partial?
I'm sorry?
Can it be partial?
No. Because if it was partial, it would be taking discretion.
And then market on close.
This is where I just tell my broker to try and get it for me as close to as close to the closing as possible.
Okay.
All right. So we've talked about a lot of this stuff already. And that makes sense, right? We talked about the order ticket. We said the opening, closing transactions. We've talked about that.
Mhm.
Okay, I guess I'm going to take a chance that you do remember this because it's a little late in the game if you don't. But I think yesterday we talked about significant market declines, circuit breakers.
Yes, I remember.
Okay, and they are.
Okay, so we have 7%.
Mhm.
It's 7%, and then it's 20%. Is it 12 or 13?
Okay, well, you tell me. So I'll help you out. You're right on 7 and 20. So you're
Yeah,
missing
I'm
the
right on 7 and 20, but I think it's
trust your first flash response.
12.
13. 7, 13, 20.
7, 13, 20.
Right,
And
okay.
so if it's a level 1 is 7% decline in the S&P
And
500,
what do we
then
do?
15 minutes.
Level 2, 13. What do we do?
It's 15 minutes again.
Level 3.
Go home.
There you go. Good job. Good job.
So 7%.
Reporting requirements. Trace are for debt securities. So the trade reporting and compliance engine. Somebody told me they actually saw that on our 7. I mean, it's in the Continental line, so it's fair game. But it is for debt securities, and it's dual reporting. It's the only reporting system where both the buyer and the seller report, and they have to do so within 15 minutes. We're trying to get the bond guys into the modern era. I mean, in stock trading, it's the sell side that reports, and you have 10 seconds to report. So obviously the bond business, a lot slower. So traces for debt denominated securities. If you get this tomorrow, I would think you would get A, B, C, and depending on what they're asking you, would depend on, what the right answer is.
Yeah, so if it's anything other than debt securities, it's within 10
Yeah,
seconds. But
that's right.
if it tells me it's debt securities, so it's
Corporate debt. Yeah, corporate debt.
Okay, for corporate.
And then, munis use what's called EMMA, the
Yeah.
electronic municipal market access. And then, as I said, all the others are going to be different. Now, delivery requirements, they have to be in the proper deliverable form, good delivery. If they're not in good delivery, the buying broker dealer is going to refuse to settle for a valid reason.
Yeah.
And so we said that we don't accept signatures of people now deceased.
That would make sense.
Yeah. If there are 2 persons on the certificate, then there's 2 persons need to sign.
Yeah.
If we want to get assignment separate from the certificate, that's called a stock or bond power. And, these are just definitional questions about what's happening in the back office. If it's a mutilated certificate, it has to be authenticated. And the person who can authenticate a certificate where the buying broker dealer must accept this has nothing to do with the customer. Customer gives me a dog-eared coffee stained certificate. I say, thank you very much. But I know that backstage, we're going to have to get this thing put or authenticated. That can be done by the transfer agent or the issuer. Every once in a while, somebody gets a dividend they're not entitled to. And a due bill is an IOU to the buyer where I say, hey, I know you were supposed to get it. You didn't. We're working on it. So again, this would be just if you get it, aim and shoot stuff, point and click stuff.
I didn't know what a due bill was.
Well, that's why we're doing that. That's why, if again, I'm just pointing out things I think that tomorrow we can grab you an extra point or something. If we haven't talked about it in our time together, it means it's a low probability. And if I'm blowing over it right now, it just means it's not important for us to be discussing the night before. Now, erroneous reports are testable.
Yeah.
And what we've got to know here is if it's an erroneous report, the customer is obligated. So Lauren, I call you and I say, hey, you bought 1,000 shares at 20. And you go, God, Dean, that was great. My limit order was 21. So 20 is fantastic. I go, yeah. And then I call you back and say, hey, Lauren, I'm sorry, man. I said 20, but it went off at 21. That is not an error in execution. That's an error in report. Now, if that happens too often, you're going to get a new broker.
Yeah.
Now, if I call you and it was a buy limit at 21, and I tell you that, hey, Lauren, it went off at 21.05, that is not an error in report. That's an error in execution. And now the broker dealer is liable. We're going to put that in error account. Do you remember customer complaints have to be handled by whom?
Hold on. For the error of like another type of question that I've seen is like, okay, I told them to buy shares of ABC, but they actually bought shares of ABD.
Well, that depends on who it's on, right? Did you tell me? I mean, that's why we need to know test question the QSIP. Sometimes the symbols are really, really close. And I know a lot of firms like Schwab, for example, if you call in and say buy ASAA and you meant ASA, but you're the one who said ASAA, that's on you.
Well, the question didn't say that. It just, I mean, all it signified was this person said ABC, but they did
We
not.
buy the wrong thing, then that's on us. We bought the wrong security, that's on us.
So do they then purchase the correct security and move it into
That's right. And then and the one that we bought, I think, just to drive me nuts with my baby brokers, I go, well, never mind. I go, well, you can't never mind. The person you bought it from accidentally isn't going to let you never mind. So that goes into what's called our error account.
Yeah.
Error account, and then we're going to liquidate it.
Yeah. Okay, cool.
Yeah. All right. So customer complaints need to be handled by a supervisor. And remember, the vast majority of brokerage firm records are 3 years, but customer complaints are right on 4 years. Good job. Now, I think we talked about U4s, and we said a yes answer is problematic. And if U4 reporting says that if something was a no, and now it's a yes, you have to amend your U4 within 30 days. You have 30 days to change what is now a yes answer from that no answer. And do you remember the 3 yes answers that were pretty serious? Conviction of a felony within the last 10 years.
Yeah, I know you have to change it if you move.
Well, no, I'm not talking about. So, well, yes, you change any answer that is now changed needs to be updated within 30 days. But we're not talking so much about moving as we are about you've done something, you filed bankruptcy, or there's a judgment against you, or something like that.
Yeah. We
said on the original U4, remember there were 3 reasons for statutory disqualification: conviction of a felony, a misdemeanor involving embezzlement of monies and securities, and have you ever been denied, suspended, or revoked registration in the past?
Denied, suspended, or revoked what?
Registration in the past. I call that the "don't we know you from somewhere" rule. You look awful familiar. Okay, so margin, as I told you, we're on 4.4 here. And I think all test prep vendors really go too in the weeds on this, but there are 3 or 4 questions and we don't know which 3 or 4 they are. And so characteristics of margin accounts. Remember, the 2 basic types of accounts at a brokerage firm are cash accounts where you intend to pay in full, and margin accounts where you intend to pay part of the purchase price.
Yeah.
And you want the broker dealer to do the balance. Now, there are very testable minimums in a new margin account, not set by the Federal Reserve Board, but set by the SRO FINRA.
Yeah.
You know these questions. We've done a bunch of them. You're going to see it tomorrow, that $2,000 trick.
Yeah. And then in a long account, the
less than 2 pay in full.
Yeah, but the maintenance requirement is 25 and a short, it's 30.
That's it. Right on. You nailed it. Approval by your manager. There are certain accounts that aren't allowed to use margin. Ineligible accounts. Ineligible accounts. This is testable.
Yeah.
And what are ineligible accounts for tomorrow? For margin.
Mutual fund.
Well, yeah, you don't buy. Well, that's an ineligible security. So I'm going to be a jerk a little bit. I didn't ask you about ineligible securities. We'll do that next.
Okay.
I asked you about accounts that are ineligible to purchase transactions on margin. The big one tomorrow is uniform. Well, retirement accounts. Right on. That is true. But the one you're gonna see tomorrow is uniform transfer minors account, my accounts. You can't
Oh,
leverage
yeah.
up the kid. Now, ineligible securities, you gave me an ineligible security, and I would know that. You told me an open-end mutual fund, but it's not because it's open-end. It's because it's a new issue. Open-end funds are continually offering new shares to the public. So we don't lend you money by new issues. I say, sorry, Reg T, the Federal Reserve Board is in control of Reg T credit extension. And they say, I can't lend you money to buy a new issue. They also say, Lauren, I can't lend you money to buy a option. If you want to buy an option, you're going to have to pay in full.
Yeah.
Now, remember, on your margin account, there's disclosures. These are additional documentation. We have an interest rate disclosure to you. That's called the credit agreement, and it's mandatory.
Yeah.
We have a hypothecation agreement, and that too is mandatory. Remember what that one is about?
Pledging your securities as collateral.
That's right. It means your securities are in street name, and that too is mandatory. There's one here that is not mandatory, and that is the loan consent.
Yeah.
And that is optional.
Yeah. And the loan consent form is basically like, if I don't sign it, I'm not allowing them to
That's
borrow
right.
my securities.
That's exactly right.
Wait, what was in the hypothecation agreement? I know that that's like pledging my securities as collateral and they're held in street name.
That's right. The name of the broker dealer, because if you don't fulfill your responsibilities, we're going to sell you out. We talked about calculations on the margin account, and the key to these is to know the classical margin equation.
Yeah.
Classical margin equation long is long market value minus debit equals equity.
Yeah.
And the classical margin equation short is credit balance, credit register, minus short market value equals equity. And then, what happens is we mark you to market.
Yeah.
And you either have excess equity or you don't. If you have excess equity, what's that?
Excess equity is always
The
50.
amount that you're over Reg T. So Reg T says you need to be at risk for 50% of the market value initially. And then it says we can loan you up to 50% of the market value of the security. So I take that 50% and say, hey, Lauren, I'm allowed to lend you some more money.
And excess equity, there's like a little equation that I memorized, and it's excess equity.
I think for test purposes, excess equity, I think SMA will be one and the same for you tomorrow.
Yeah, equity minus 50% LM.
Yeah, but that 50% is what we're comparing it to see if you have it or not.
LMV or SMV. Okay.
And then they're going to say, how can you meet the margin call? Margin calls are T plus 2 plus 2. Maintenance calls are due promptly. That's when you go below the 25 or 30. House requirements can always be more stringent.
Yeah.
If I'm a margin clerk and any money comes into your account, I pay down your loan. So, you don't need to call me and say, hey, pay down my loan. I said, well, that's what we do unless you tell me differently.
So when it's like when I sell something in a margin account, so money is coming in, it's going to pay down my.
Yeah. Now we're just going to go. So now what we're going to do is we're just going to go and look in some of these footnotes and talk briefly about these footnotes.
Fun.
Yeah, fun. Our last time together doing this kind of thing. I know you're just thinking, man, how am I going to live without spending hours with Dean talking Series 7?
I actually will miss this.
Okay, so we are going to be talking about, for example, customer complaints, which we said were a 4-year record.
Yeah.
We said that the price is binding despite an erroneous report.
Yeah.
That's what we said there. We didn't talk about the code of arbitration, but remember the code of arbitration is testable. And in arbitration, remember, all decisions are final and binding. Final and binding.
Yeah, but if they don't come to a decision, then.
Well, if it's a state that requires mediation, we have to try that first.
Yeah.
Okay, so we're just going up here. DK means we don't know a trade, and so that means back office has to fix that for us. We talked at length about the Uniform Practice Code, which standardizes practices within the securities industry. Ooh. We said the Options Clearing Corporation allocates exercises notices how? Very testable,
At random.
right? And how does the firm do it?
The firm. Well,
Random, FIFO, or another fair method.
oh yeah, the firm will do random FIFO.
Or another fair method.
But if I choose, right?
Mhm.
So if
Yeah, well,
I
if you're
choose,
long, what do you mean well, yeah, you're long, you can exercise whenever you want. So you're going to
yeah,
contact your broker dealer, they contact the OCC contacts a firm.
yeah, okay, and then the IRS, they're gonna do what benefits them, so
Well,
it's gonna.
that's not about options, that's about stocks.
No, I know, I'm just thinking.
Yeah, yeah.
So the IRS is gonna
And
do
trading halts, you got the trading halts as we come back the other direction on this stuff.
trading halts.
What were the trading halts? Circuit breakers?
Yeah, 7/13/20. Okay, I feel like I know a lot of this stuff.
Oh, listen, you know plenty, you don't weigh more, you don't need any more than you got, so you're in great shape, you're in great shape. Just again, we're just looking for any little freebies, any more freebies we can find
Yeah,
within this.
can we make sure, I know that this is gonna be on there tomorrow, like my gut is just telling me this. Like the balance sheet stuff.
Well, you know, balance sheet, remember, is this stuff. Let's just go back up where we had the section here.
Yeah, well, I'm just
Uh,
thinking, it's like, how is this going to impact the,
Well, so, you know, again, this is called corporate actions affecting the balance sheet. The big one is going to be how does a dividend affect working capital, for example? And
Mhm.
remember, when the company declares a dividend, it becomes a current liability, so working capital falls.
Yeah, so
Here's
working capital is going to decrease
Here we go. Here's this section right here. I'd be
when.
surprised, you know, I now have a couple lectures on balance sheets, but when I started my channel, for about the first year and a half, people say, you don't have anything on balance sheets. I said, I don't have it because I just don't think it's going to be important to your success.
Yeah, so working
But
capital.
that being said,
Uh-huh.
here we have principal tools to measure financial health. And that's where the most of it comes from.
Mm-hmm.
Right. And so here, if we're talking about the liquidity, you talked about how do things change things. The one they can ask, and they do ask, is how does a dividend affect working capital?
Uh-huh.
You got to be careful. A declared dividend causes working capital to decrease.
Yeah.
As remember, a declared dividend becomes a current liability. Now be careful. When the company pays it,
Yeah, it's not affected.
that's right. Now, we also want to know of our liquidity ratios. There's three there. Those all could be testable.
Yeah.
And then we have things I could say, for example, what's the effect on the debt to equity ratio if we pay off a bond? And you say it would improve, right? Because now we don't have any borrowed money as part of our capital, or less borrowed money, depending on what we're doing, right?
So debt to equity ratio would.
Well, you're just said you know you're going to get, or you said you think you're going to get. How do things affect the balance sheet?
Yeah, but I'm thinking, you said improved, but I don't really like that word to use there. So
Oh, okay. Well, I don't know. Well,
like,
because yeah, you're right. Right. Yeah, well, I forget you come from a place where you guys do business in distressed securities. But, you would decrease the leverage. I'd like that better.
so the debt to equity ratio would decrease because.
Yeah, because if you pay out, it's just like I think the easiest way. I wish I had some magic pill. I think the easiest way for people to understand balance sheets. This is really embarrassing, Lauren, but
Yeah.
I was actually in charge of a balance sheet of a business, and for years before I actually understood what I was doing. And then one day the lights went on. Oh my God, I finally get it. I was too embarrassed to go tell the person I work for. I finally figured out what the hell I'm doing. Watch out, world. I'm dangerous now. So I think because that clicked for me that way, I think it's easier for people to think of their own personal balance sheet. Right. And so I don't know how leveraged you are or are not, Lauren, but if you
Uh-huh,
pay down your loans, that would mean you're less leveraged, right?
uh-huh,
You know, my brother, we're both my brother and I, he's been kind enough to help me go along on the adventure with him on this thing off grid, right? And he was talking about how he might borrow some money. And I said, well, Chris, why would you want to borrow any money? I mean, isn't the point of going off grid that you don't owe anybody any money? I mean, I'm not one of these prepper guys living off the grid, but I thought that was part of it. And I said, you know, hey, as your brother, I'd be happy to loan you whatever you need there, because you better to own the bank of Big Brother than some real bank that might come take your stuff. Right.
mm-hmm,
But if you
mm-hmm,
have no debt, you know, that's more conservative
yeah,
than it is, right? Okay,
yeah,
so here we go. Well, you have inventory. You have inventory.
mm-hmm,
We don't want to have to sell our inventory to pay our bills, right? Because we wouldn't
yeah,
get the margin. So the quick assets are the current assets less the inventory, also known as the asset test ratio. And that's where we toss out the inventory. Now, when we have inventory, we can use last inventory in is first inventory out, or first stuff into inventory is the first out. My question to you is, what probably will give us the bigger margin, where we assume that the last merchandise we put into inventory is the first merchandise we're selling, or the first merchandise we bought is the first merchandise we're selling?
first in, first out,
Yeah, right. Because we would assume that in general, that would have the lower cost.
which I would make more money.
Yeah, that's exactly right.
Yeah.
Exactly right. Okay, well, young lady, I think that's it. We did our low budget Greyhound bus tour. I'll be sending you some positive energy. I think you have my cell phone, but do not call me from the exam site tomorrow. If you need a little rah-rah, you're welcome to reach out. But I had this lady, I said, where are you? She goes, I'm at the exam site. I go, oh my God, hang up now. I don't know how you still have your cell phone, but you know.
I know. Oh my God.
No, at 8:30, I'm going to be sending you positive energy. You know what happens sometimes, Lauren, is sometimes you'll be taking the test and all of a sudden you go, oh my God, I can't remember anything about Series 7. Don't panic. If that
Mhm.
happens tomorrow, I want you to just take a break. And I'm going to astral project that back to you from Las Vegas. Now, it might take me a minute, so you know, don't panic. You know, it might take me a minute to pick up the astral projecting, but when I do, I'll send it back to you. Send it back to you.
Yeah.
Okay.
Yeah.
I'm excited for you. You worked hard. You were dedicated. You were disciplined. You were organized. So I can't imagine you're going to run into any problems tomorrow. Just get a good sleep. I know you well enough from our tutoring sessions that I know you're not going to put it up and be done with it and just rest today. But do me a favor, keep it low key.
Okay.
Don't get into the weeds on anything. You know, if
Yeah.
you're tempted to get into the weeds, you're not sure you're getting into the weeds, please do reach out. Give me a call or give me an email so I can do an intervention and say, no,
Yeah.
Lauren, don't go there. So,
There was there, I promise this is my last
yeah, no,
question.
no worries.
There was one thing, where is it? Yeah, like there's two sections in this, basically like key testable or key topics from Notman. Again,
Although
I
I love